Most retirees don't realize this, but a simple deposit into your checking account could trigger tension from the IRS, create tax headaches, or even lead to thousands of dollars in unnecessary losses. And here's the scary part. Many seniors think they are breaking a new rule when they are not, while others completely miss the real risks hiding in their bank activity. You worked decades to build your retirement savings. The last thing you want is to lose money because of confusion, outdated information, or a mistake that could have been avoided. Today, we're going to uncover what these so-called checking account limits really mean, and what every retiree should do right now to protect their money. By the end of this video, you will learn what bank transactions actually get reported to the government, which deposits may attract IRS attention, the costly mistakes retirees make with Social Security and retirement withdrawals, and the simple steps that can help protect your savings from unnecessary taxes, penalties, and stress. Stay with us because one of the final sections surprises many retirees, and it could save you thousands over your retirement years. Before we begin, take a moment to subscribe to the channel. People who subscribe usually learn these financial changes before it's too late. Rules change, reporting requirements evolve, and staying informed can help protect your retirement savings for years to come. Now, let's get started. One of the biggest challenges retirees face is that government agencies rarely notify people directly about financial changes in a clear and simple way. The IRS doesn't call every retiree to explain reporting rules. Banks don't always explain why certain transactions are flagged. And many people only discover a problem after receiving a notice in the mail. That's why staying informed matters. Because when it comes to retirement finances, small misunderstandings can sometimes turn into large losses. And the first misunderstanding starts with this idea of a checking account limit. Let's clear up one of the biggest myths right away. The IRS has not announced a new law saying retirees can only keep a certain amount in a checking account. Your bank balance itself isn't capped. However, banks are required to report certain types of transactions to federal agencies. And this is where confusion begins. This affects virtually everyone with a bank account. But retirees are especially vulnerable because many receive Social Security, pensions, retirement withdrawals, and occasional large transfers. Imagine selling a vehicle and depositing $12,000 into your checking account, or moving $25,000 from savings to checking for home repairs. These are common transactions, but if documentation isn't clear, they can create questions later. Over retirement, confusion around reporting can potentially cost thousands in taxes, penalties, or professional fees. One mistake some retirees make is splitting deposits into smaller amounts because they think it avoids attention. In reality, intentionally breaking up deposits to avoid reporting requirements can create even more problems. The safest approach is simple. Keep records. Save sale documents, transfer records, inheritance paperwork, and withdrawal statements. If money enters your account, be able to explain where it came from. Documentation is your best protection. And speaking of withdrawals, the next issue catches many retirees completely off guard. Once many retirees reach the age required under federal law, they may have to take required minimum distributions, often called RMDs, from certain retirement accounts. Simply put, the government eventually requires withdrawals from tax-deferred accounts. This mainly affects retirees with traditional IRAs, 401k, S, and similar retirement plans. Suppose you have a retirement account worth $500,000. Your required withdrawal could easily exceed $20,000 in a year depending on your age and account balance. That extra income may increase taxes and affect other parts of your retirement planning. Over 20 years, tax inefficiencies could reduce retirement wealth by tens of thousands of dollars. A common mistake is waiting until the last minute to take withdrawals or failing to plan for the tax impact. Some retirees even withdraw too little or misunderstand the rules entirely. The best action is to review your retirement accounts every year. Estimate how withdrawals affect your taxable income before moving money into your checking account. A little planning today can save thousands later. But taxes aren't the only concern. The next issue affects millions of retirees receiving benefits every month. Many retirees believe Social Security is always tax-free. Unfortunately, that's not always true. Depending on your total income, part of your Social Security benefits may become taxable. This especially affects retirees who receive Social Security while also taking retirement account withdrawals, earning investment income, or collecting pensions. For example, withdrawing an extra $20,000 from a retirement account in 1 year could accidentally increase taxable income. That may result in hundreds or even thousands of dollars in additional taxes. Even paying an extra $200 per month in taxes adds up to $2,400 per year. Over a 20-year retirement, that's nearly $50,000 lost. The mistake many people make is focusing only on the amount they withdraw while ignoring how it affects Social Security taxation. Before making large withdrawals, calculate how they affect your total income. Spreading withdrawals across multiple years may help reduce tax surprises. Always look at the bigger financial picture, not just the amount entering your checking account. And there's another banking habit that many seniors think is harmless but can create unnecessary scrutiny. We'll cover that next. Many retirees don't realize that frequent cash deposit can create confusion, even when the money is completely legitimate. Now, depositing cash is not illegal, but banks are required to monitor certain patterns and report suspicious activity when necessary. This affects retirees who receive cash payments, sell personal items, help family members financially, or keep cash savings at home. Imagine a retiree who sells collectibles over several months and deposits $3,000 or $4,000 at a time without keeping records. Years later, if questions arise, proving the source of the money may become difficult. One common mistake is assuming that cash itself creates problems. In reality, the issue is often poor documentation. The best action is to keep receipts, bills of sale, and records of where cash came from. When possible, maintain a paper trail. Doing so can save thousands in legal fees, taxes, and unnecessary stress later. But perhaps the most expensive mistake retirees make has nothing to do with deposits. It involves where they keep their money. Many retirees keep large balances in checking accounts because it feels safe and convenient. Unfortunately, that convenience can quietly cost money every year. Checking accounts often pay little or no interest. Meanwhile, inflation slowly reduces purchasing power. This affects retirees who keep emergency funds, inheritance money, or retirement savings sitting in low-yield accounts. Suppose someone keeps $100,000 in a checking account earning almost no interest. If high-yield alternatives earn even a few percentage points more, the difference over retirement could exceed tens of thousands of dollars. Over 20 years, that lost growth could potentially exceed $100,000. The common mistake is confusing accessibility with financial efficiency. Money needed for monthly expenses belongs in checking, but long-term funds may deserve a better home. Review your cash holdings regularly. Consider whether excess funds could be moved into safer interest-bearing accounts that fit your retirement goals. And now we arrive at one of the most overlooked issues of all. This final point surprises many retirees. Scammers increasingly target seniors by pretending to be from the IRS, banks, or government agencies. Many victims lose thousands before realizing they've been deceived. This affects virtually every retiree because fraud attempts to become more sophisticated than ever. A scammer may claim your account exceeded a reporting limit or that immediate payment is required to avoid penalties. Fear causes people to act quickly. The money involved can be devastating. Some victims lose $2,000. Others lose $20,000 or more. Over retirement, financial fraud can erase years of savings in a matter of hours. The most common mistake is responding immediately to unexpected calls, emails, or text messages. Remember this. The IRS generally does not call demanding instant payment. If you receive suspicious communication, stop, verify independently. Call your bank directly using the number on the back of your card. Visit official government websites. And never send money because someone creates urgency. Let's quickly review what we've covered today. There is no official IRS checking account limit that caps how much money retirees can keep in the bank. However, reporting rules, retirement withdrawals, Social Security taxes, documentation practices, and fraud risk can all affect your finances. The key lesson is simple. Most retirement losses don't happen because people work too little or save too little. They happen because of confusion, outdated information, or small mistakes repeated over time. Protecting your retirement doesn't require complicated strategies. It requires awareness. Keep records. Plan withdrawals carefully. Review your accounts regularly. And stay informed about changes that may affect your money. A few minutes of preparation today could save thousands of dollars tomorrow. If you found this video helpful, Subscribe to the channel and turn on notifications. People who stay informed often discover important financial changes before they become costly mistakes. And if you know another retiree who could benefit from this information, share this video with them. Your retirement savings took decades to build. Taking a few simple steps now can help protect them for years to come. Thank you for watching, and we'll see you in the next video.